So I think we are familiar with the word sensitivity and analysis. So for both of us that we are just hearing that for the first time, so I will try as much as possible to make the note concise. Then we go into practical questions. I'm sure. Let me share my screen with you guys. So I'm coming. I'm trying to reach out to my guys so that they can permit me to share the screen.
Okay, you want to share screen? Oh yeah, let's. I think it's what I turned off the video. That's why I turned off the video. That's why. Confirm if you can share screen now.
Yes, I can share now. Thank you. You can you guys change the screen now?
Yes, sir. We can see it, sir.
Okay, thank you. So, like as I was saying,
Please zoom it, please. It's very tiny.
okay, okay. Is it fine now?
Yes,
Is
it's
it okay
okay.
now?
Yes, it is.
Yes, it's fine now.
Thank
Okay,
you.
thank you. So, as I was saying, um, scientific analysis is an investment appraisal is a technique for assessing the sensitivity of a project's return or the NPV, so to the variation in each of the items of costs or benefit in the project. So, in just a layman term, for example, imagine I want to invest in a business and I'm expecting, let me say, 100,000 naira to profit a year. So, what I'm expecting is that, or how sensitivity works is that, what if my sales drop by 10%, or the cost increase by, let's say, 5%? So, which just changes affect my return, my 100,000 return I'm expecting. So that's just a short, like just a layman understanding of sensitivity analysis. I mean the changes of the revenue or costs. So in relation to the return on the project.
Sorry, sir.
So the
Please,
technique is
can you help us talk to them to off their cameras, please? It's disturbing.
okay. Please, those of us that are putting on camera, please, you are not doing a visual interview here. Please off your camera, please. Oh. Okay. So as I was saying, the technique is to take the estimates for each uncertain factor one by one So, like, I mean, the sales, the revenue, the cost of capital, so the sales volume, selling price. So those, what do you call it? So those margin, you take it one by one. So in relation to the return you are expecting on that particular project. So, for example, if scientific analysis is to be carried out, it's often used to calculate the net present values to each factor or cash flow item in such a way that the present values are found of individual elements of costs and revenues over the life of the project. So, like I just said, so just like taking those each of the indicators in relation to the profit or the return you are expecting for that particular project, like taking each of them and to know how changes there will be. So if they change, so will they affect the return you are expecting from that particular project? So that's just a short what do you call it? Explanation on sensitivity analysis. Please mute yourself. Oh. So can we move on, please? So let's go to the illustration. So we already know everything about the investment appraiser. So you guys have already done that. So I'm just relating scientific analysis to investment appraiser, how they relate. And I think through the short explanation, we're able to get the relationship between both of them. So we have to get the present value first before even saying you want to calculate the changes of those indicators, how they affect the returns, or how the the variables, how they are computed. So in relation to the return of the particular projects, must have gotten your MPP first. So just as a continuation from investment appraisal. Please, who can help us with these illustrations? So we have 1, 2, and 3. At least we can be able to tap 1 and 2 tonight. Then I think we have a good start on that. Please, who can help us with the illustration?
Can I read it, sir?
Please, yes, ma, you can go on.
Okay, illustration 1. The following information relate to Apex PLC. Initial outlay, cost of finance 50 million. Project life 4 years. Annual sales volume 72,000 units. Selling price 2,000 naira. Variable cost per unit 1,500. Relevant fees cost 7 million. Tax rate 30%. Capital allowance 25% straight line. Cost of capital 10%. A. Determine whether the project of Apex PLC should be undertaken. B. Calculate and interpret the sensitivity margin to 0.1 selling price. Second point, sales volume and determine the break-even unit. 3. Total variable cost. 4. Fees cost. Then the fifth one, cost of the machine.
Okay, thank you very much. So please, I think you have this. We have the material already. So I'll be just be. So you'll be checking your material. Then I will be using. No, I can't share the listen. So I'll be using the Excel, the Word format. So you just be checking your material for the question, so that you won't be going back and forth, me sharing them, checking the question again, so that you can actually treat the this thing as fast as possible. Please confirm if you can see my screen.
Yes.
Yes, sir.
Okay. Okay. Thank you. So as I was saying, so every indicators you are choosing, I mean the selling price, sales volume, cost, initial capital, cost of capital, the project life. So every indicators. So you are asked to do in any particular question. So it must be in relation to uh, the MPV of that particular project. So from our question, we are asked to calculate Apex PLC. So it should determine if whether the project should be undertaken. So you have to, like I said, you have to get your MPV first before determining the sensitivity of any particular indicators you asked to calculate. So let's assume all these are in millions. So we already know all this. So I want to wait much of our time. Well, we have the initial. So what's our initial outlay?
50 million naira.
Okay. So is it which year is that? Which year would that be?
Yes, zero.
So year zero. So we assume all figures are in millions. Then we will get our profit. So for us to get our profit, then let's try and do a short workings. Let that be a short workings. Hope you are seeing the screen. So what's our selling price?
2,000
2,000
naira.
naira.
Then do you have any cost there? We have our variable cost, right?
Variable cost, yes.
So how much is that?
1.5.
Okay.
We have relevant fixed cost.
Is it relevant?
Yes.
Yeah, yes, let's do that contribution first. So, so what's our contribution?
500.
500.
Okay. So don't forget, the sales they are in volumes. You understand? So what's the volumes of the sales?
72,000. 2,000.
Then you have a total contribution, right? So that should be how much is
36 million.
36 billion.
36 6 million. Okay. So you haven't let our first cost. You have first cost here. So what's our first cost?
7 million.
So what's the balance we have?
29 million.
20. So do you have any? So after the fee cost, do you have any depreciation?
Yes, we have capital allowance.
Okay, capital allowance. That is what percent?
25% straight line.
So how many years? That is 4 years, right?
Yes.
Okay. That is 50 million. Okay. So that's how much?
12, 500. 12,500,000.
Okay. Do you have any tax?
Yes.
So that what's our profit first before tax? That's profit. Tax. What's our profit? Don't forget you put this. Oh yeah, oh yeah. Oh. Please, are you
16,500. 16,500.
okay? Then we have that's the taxable profit. It's the same thing. So then our tax. So 30%. So what is 30% of this our taxable profit
Four
or
million
our
nine
profit.
fifty thousand.
150.
4,950,000. Not four.
2,950.
Oh, okay, 4 million. Right?
Yes, sir.
So let's move. So what's our profit? Our what's our
16,
profit? Yes, I mean our cash profit. What's our profit?
16,500.
No, before the you won't like start from here. You understand? Before tax. I mean before tax, yeah.
Yes, it's 16,500.
Before tax is 29,000 now.
No,
I mean our cash profit before the depreciation, sorry. Before deducting depreciation.
29
That's
million.
20.
39 million.
29 million.
That's for how many years?
Oh yes.
So that right? Then our tax. So if you have to deduct tax, what's our tax?
4,950.
4.25.
Then you need on today 495, right?
Sorry, sir. The project life cycle is 4 years, not 5 years.
4 years. Oh, sorry. That was what I asked you to, because I'm not with the question now, so I'm just solving. You understand, please. Okay. So what's next? So what's our profit now? So what do we have? We have 50 here, right?
You have 24.05, sir.
In year one, right? Or where each year?
Yeah, 1 to 4.
4.
All the years, sir.
Okay, all the years. 24.05.
05.
Okay. So what's our what do you call it? Our cost of capital.
10%.
10%.
Sorry,
10%.
sir. What about our tax save on capital
How about the
allowance?
capital allowance?
You said
Capital allowance. You say you give us capital allowance. Tax on capital
Not
allowance.
using it.
We've done the capital allowance now. We've done the tax now. Which one are you talking about?
Are we not bringing in the tax savings? Are we not supposed to
No,
compute for tax savings?
no. Are we told? No, no.
It's not in the question.
I'm not getting you guys. Oh, you said the tax savings, right?
Yes, capital
We
allowance
have
20,
capital
25%.
allowance. Capital allowance.
25% straight line. Straight line, sorry.
But it's on a straight line now.
Yes.
Yeah, and we have done that already. Which one are you talking about?
We have used it in the working.
Yes, it's already in the working now. This
Okay,
is
okay.
straight, what they call it, a straight line. You calculated. Hope we are cleared.
No, sir. If you can walk
Hello,
us
sir.
through
If
the
you can work, if you can.
So this is what they call it on the straight line. This is the what calculated. So it's on a straight line, and for 4 years. Do you get? So the person asking question, have you got the answer to your question now?
Yes, I'm trying to understand, sir.
They said the was is on a straight line. Do you understand? So the reason we use this thing for 4 years, and this per year, this is what they call it. Have we got it now?
Yes, sir.
No,
If
sir.
you are
Sorry.
bringing in
Are we
the
supposed to less the capital allowance or the tax savings on capital allowance?
hello, sir. You
From
did
the
not
what?
factor in the capital allowance and tax savings from this your computation.
From what they call it, we
So if
already
we are
talked.
bringing
You said
in the capital allowance, then we need this not the cash profit. This not the cash. This not the inflow that we need to capture there. And again, if we are picking this, then we should add the capital allowance. That's the tax saving. We should include the tax saving.
but from here you are
That's
using the
if we are
cash
going
profit
this
for.
route. If we are going this route, we should bring in the tax savings, sir.
You mean the
Hello, sir. Should I
no,
go?
you are using the cash
We are using
profit
the cash
directly here. Please move to yourself. I can. You are using the cash profit directly here. Do you understand?
Okay, I kind of understand, but we are not used to this method, but it's still the same thing, sir. I
It's still the
understand.
same. You understand what I'm saying
It's
now?
still
So
the
you are
same
using the
thing.
cash
Yes,
profit
yes, I
directly.
understand, but we are not used to this method. We are used to getting the tax savings, then you now charge tax on it, but it's still the same. It will still give you the same
Exactly.
four
So
point nine five. Yes, exactly.
exactly. So you still get the same answer. So I'm just like making it so because you already worked the
But this
this
one
thing
is
already.
this one is even more
You
faster,
understand?
sir.
Exactly. So you already have your what they call it. Just use the once you get your normal do your normal workings, just go to do your maybe the next question what they call it, you might try the other one. That's fine, right?
Yeah, but like
So
for
please,
people that don't get, if you charge if you charge the tax saving, the capital allowance on the project, that is 50 divided by 4. It will give
mm,
you, what is it called? 12,500. Then
you
if you
already
charge
got it that.
30% on it.
You already got
No,
it
no,
that. Yeah,
I'm just trying to like explain to people that might be confused on this method or something.
okay. What we just need that, for example, after the initial what you call it. So supposed to use this 12.5%, you understand? Then 30% tax savings. So if you deduct it, you see have same what they call it.
No, I did it. I got the same thing. It's okay, sir. Continue.
So you still got the same thing. So please, your discounting factor, I don't this is 0 point. So this is one already. This is
0.909.
9.
901.
0.826.
So this is what?
0.751.
51.
1.
0.683.
So see, I have normal same figure here. So what do you have here? Oh yeah, please. Someone should be help us calculate this. What do you have? Which one should do for year 1, 2, 3, and 4 so that we can just have the figures. I mean,
Year 4,
So for year one, we have 21.86.
20.9. Then year 2.
16.4.
What's year 2?
Year 4, 16.43.
Okay. 16.43. So what's year 3?
18.06.
18, right?
0.06.
Is in 06. Okay.
18.01.
Which one is that?
Year 2,
We are using
19.87.
2 decimal places, sir.
You said you are
19.87.
using 1 decimal, right?
We are using 1 decimal place. It's just 18.1. Yes, sir.
Okay. Then 19 points.
87.
That is 19.87. 19.9. Since we are using
Year 3 is 18.06. Okay, we're using 1 decimal place.
yes.
If
So
you are
what's our
using 1 decimal place, then this year 1 should be 22, then 22.0.
Exactly.
no 1 decimal now is 1 decimal. Oh, what do we got in year 1? What's the figure there?
It's correct, sir. 21.9.
Okay. So what's our MPV, please? Yeah.
MPV is 26.3, sir.
26.3.
3.
That's our MPV, right? So we have so that means from A now. So since we have a positive MPV, it means the project should be undertaken. That's just interpretation, right?
Yes, sir.
Then B, what they are supposed to do?
They said you should calculate and interpret the sensitivity margin to 1 selling price, sales volume, and total variable cost.
Sales volume, then total variable cost. Okay.
Fixed cost and cost of the machine.
You missed one of the requirements for the option 2. Sales volume and determine the break-even unit.
Okay. So to get let's get the selling price first. I mean the sensitivity of the project or NPV to the selling price. Okay, now let me just put this way. So can someone assist us with the formula to be what? So you have the NPV divided by the present value of this is selling price, right? So the total sales. So that is total sales like that is after tax. So you have to less tax. So but now we don't know our the present value of total sales. So for us to get the present value of the total sales, so let's do a small working. So we have annual sales, right?
Yes.
Annual sales.
72,000 units.
Let me put all these things. Products. That's 70,000, right? So there was the sales volume. Sorry. Well, the selling.
70,000 price is one price, sir.
Selling price one.
So what do we have? So this is the what do you call it? This there is selling price then the sales volume. So what do we have?
144 million.
144 million, sir.
Okay. So since we say it's after tax, please don't forget. So our tax is still remains 30%. So what do we have?
Yeah, for 3.2, sir.
3.2.
43 point
Two. 100.8.
okay. That's 100.8, right?
Yes, sir.
Yes.
Someone say no. Oh. No, we are told you have to check for the present value. Please don't forget. Hmm? So no, this is like for the what they call it. So you have to discount it. No, it's for 4 years. Don't forget. So we have to this is a new we have to from 1 to 4 years. What's our annuity? If you are using this, if you want to do it for 4 years, what will be our annuity?
3.1, 3.17.
So what percent are we using?
10.
Okay. .17. Okay. So we have our present value because That's what we are told to calculate our PV. So what our present value?
319.5.
So 319.5. Is that it?
Yes, 319.5.
So we have gotten our, what do you call it, the present value for the, so what's our MPV? 23 point, right? So 319.5. So what's our sensitivity of our selling price?
Should be 0.08.
In percentage, sir.
You said?
It should be 8%.
In percentage.
Yes, it's percentage.
8%.
8.23.
8.2%.
8.2.
8.2%. So what will be interpretation? So the
The
interpretation,
total price should not fall below 8.2%.
so that means the selling price, so falls by what? It falls by what the percent? Selling price fall by 8.2%. That means if selling price fall by 8.2%, the return, the MPV will be zero. Yes, and that means if selling price fall by more than 8.2%, so our MPV will be negative. Do you get? So when selling
Sorry,
price
sorry,
fall,
sir. Please come again. I didn't get that. My network was shaking.
I said the interpretation will be if selling price falls by 8.2%, that is the MPV will be zero. Then if selling price fall more than 8.2%, you know, we said if it falls by 8.2%, the MPV will be zero. If now fall more than 8.2%, that means the MPV will be negative. Do you get? Or I
No,
should
sir.
just,
Yeah, yes, thank you.
I beg, take it again. I beg, sir. Please, let us take it again.
it's because I'm thinking writing it might take a long, so but I'm not problem. So if if selling price uh, falls by what's the percent? 8.2. So did you get it now? So if selling price falls by 8.2%, the MPV will be zero. Thus, If selling price for more than 8.2%, then our MPV will be negative. So if selling price, so it means you can't grant more than 8.2% to a customer as a discount. That's what it means. So this can we move on? So this is just the selling price.
Sorry, sir. Can you just help us to scroll to the workings so that we'll just screenshot it, please? Sorry.
This one?
No, the workings. Yes.
Okay. Okay, do you know what I will do? Let me move this forward. Okay, I should have put the workings down, up here. The nation should be down. But when I'm saying that I will do that, sir. Have you done that?
Thank you. Yes, I have. Thank you.
Okay. So let's move forward. So what's the next one? We've gotten the selling price. Let's get the sales volume, right? So let's get the sales volume. I think the so what this one will be is what it will be the MPV divided by what? The present value of what? Since we're using the sales volume, the sales volume incorporate the sales and the variable cost. That means you are using the total contribution. Hope you know.
Sir, please explain. No.
I said since if you are using the sales volume, so we be using the contribution, the present value of total contribution. So down to the after tax. So what's the so let's get our present value of the what they call it, the present value of the contribution. So how do we get that? As after tax.
That's sales minus variable cost. Then with less tax.
Okay. So do you have that already? I think we already have
We've
our contribution.
completed it before. Yeah. So
So what's
just compute after tax.
our contribution is 36 million, right? From our computation, our contribution is 36 million.
Yes, sir. Contribution. Okay.
So let's take the tax. So 30% of this 36 million will be what? 36.
10.8.
10.8. Sorry. No, if I could do this, it will be, is it 10.8? So let's
Yeah.
10.8 from 36. What do you have?
36 into 1 minus 0.2.
5.2.
You can still do this. You can still say 1 minus 0.3. They said so anyone. But let's use so that we won't get confused. We used to have, use so what do you have here? So what do you have here? Oh yeah, yeah. What do you have as an
25.2, sir.
okay?
Hmm?
So what's our native? That's 1 to 4 years. Someone should help us.
At 10%, we've already done that. 3.17, sir.
Okay, see the same thing. So what do you have?
79.9. 79.9.
9.9.
79.88.
Right. For one
9.9.
decimal, that's on to 9.9. So
Is that
what's
with the video minus 0.3?
you said? You are saying something.
I said that, so why did we do 1 minus 0.3?
Is the tax? The tax is 30%. No, we are the contribution is after tax. So you can do 36 times 0.3. Then what we get, we minus it from 36. So you say it's to still get this.
Okay, thank you, sir.
Yes, I just do it in
Please, how about the amenities, sir? Please, can you kindly explain the amenities part of it, Abeg? Please, sir.
you said?
The amenity 3.17. Oh, okay,
So
I've seen
that
it.
is
I've
four
seen it.
years. That is 4 years. So what is the interpretation? It just means that if the sales volume, so just interpreting it, know what you get before the selling price. So now it is sales volume. So if the sales volume, it's still the same thing. So if sales volume followed by no, we're not gotten our this thing now. We've not gotten our
Our
normal
sensitivity.
exactly.
Because I was wondering, this is a figure, it's not a percentage.
Please, you're not gotten our sensitivity low. Oh yeah, yeah, yeah. So what's our sensitivity? What's our sensitivity? Well, no, our
Can
MPV
you
now.
scroll up a bit?
MPV is
The
26
PV, 6 points.
Then what's that contribution? That's 79.9. Abi?
Yes. That will give you 32.9, sir.
That is 32. 2.9. So we'll come here.
That's it.
So that means if the sales volume falls by 32.9, so the MPV will be 0, right? Plus, So the sales volume falls by same thing. But no, you are told to get the break even, right? So if you are using break even, if you are using break even, no, if you are using the what they call it, the sales volume. So that's where you determine the break even. So for interpretation, it will just be if the sales volume falls by 32.9, then the NP will be 0. Then and we will have that will be a break even point. So for us to get the break even point now, I'm coming the NP will be 0 and so that'll be break even point anyone. So the break even point now, no, you are talking about the sales volume. You understand? So if you have to get the break even now, so what's our sales volume?
72,000.
Eh, so no, our sales volume is 70,000. We have multiplied 70,000 by the tax element. I mean, no, you have this already. You have this 32 points this already. So it multiply this
That should be
32.9.
100 minus this.
You said?
Should it be 100 minus
No,
32.9?
no, just be what's our this 32.9?
32.9.
So 1 minus 32.9 times the sales volume. Do you get? Because you want to know the break. Though this is sales volume, sales volume, but you want to know the break even point. So for us to know the break even point, it will be 1 minus this sales volume. Do you understand?
Yeah. Okay, that means this 32.9 now will now be 0.329, not 32.9%.
No, see, it's same thing. You see, yeah, no, it's in percent. It will be 0 minus this 1 minus 1 minus 0.329.
Okay.
Then time multiply by, okay, let me illustrate it here. It will be one
That will give us 0.671.
so what do we have?
We're getting
That's
48.31. 48.3.
So the break even volume.
48,312.312. What is 312?
So
But 8.3. You're using 3 decimal places.
so it means if the what do you call it? If the sales
I have
volume
a good
falls by,
sign, sir.
this one is in thousand, not point. Okay, I'm with you.
I wanted to say this is in thousand because it does not have yes. Okay.
Yes, it's in thousand. Thank you.
All right.
So
Cool.
what it just means is that if the sales volume falls more than 33 32.9 here, it means the MP will be negative. Hope you get.
So please can you please explain the gateway here? I do not get into that. I'm not a perspective.
Sorry.
So what I'm saying is that the break even it raised the sales volume. Understand? So it just means the what you're getting your sales volume already. Then just to know your break even, the amount at which you break even or the break even volume. So because I think we are asked to do that in the question. So just less the what they call it. So just one minus the sales volume obviously you get. You understand? Then you multiply by the total sales volume. So you have your break even volume units. Do you get?
Okay, sir. Thank you, sir.
Sorry, sir. This one minus, is it a standard formula?
Of course, it's a formula. Once you get your sales volume, then the sales volume for you to get the break even, you understand? Just one minus the what they call it.
So is the only contribution that we calculate break even?
Yes, mostly so yes, contribution.
Okay. Then I want to
So
ask again. Sorry, sir. I want to ask again. If we have like more than 1 year, if we have different contribution for each year, how do we um how do we attend to
calculate
that?
it, right?
Yes.
I don't think the examiner will not be quiet enough to give you contributions more than so mostly just you have a normal and the sales unit to be the same thing. And also once you get your sales or what they call it. So no, this one you are doing now, you are doing it for full, like you are using the annuity factor to get
Yes.
to get the 4 years at the stretch. Not that you're
Yeah.
calculating 1 year by one. No, that would be more stressful. That would be more stressful.
And for us
And
to calculate annuity, that means our cash flow is constant for each year.
yes, exactly. Yes. No, they can't give you different kind discounting factor for a year. Just same discounting factor you use for all your what they call it.
I
Just say
understand.
oh, yes.
Thank
I
you.
don't have it's very
Okay.
very yes. So what's the next one we are asked to calculate or asked to compute?
Total variable cost.
So just the then to be present value of what? Oh yeah.
Variable cost. Total variable cost, sir.
So don't forget to after tax.
After tax.
Okay. So what's our let's get our present value. So let's get our present value for variable costs. So what's the variable cost? What no we have to also get the variable cost now. Do we
108
have the
million, sir.
you said
1,005. The total is 108 million, sir.
so, including tax or excluding tax? So
Excluding tax, sir.
and
That's one
then
five times 72,000.
like 1.5. Right. So what do you let's multiply. Okay, what's the tax? What do we have?
30%, which is 32.4.
Okay, we less that from the
We'll have 72.6.
72.
75.6.
Which
75.6.
75, sorry, 75.6.
75.6.
okay, so what's our what's the final
Salary
answer?
annual contribution instead of total variable cost.
Sorry.
No, under, beneath. Yes, yes.
We have 239. 239.6.
It's 9.7.
Okay.
So this tax you left it at just 1 point, just 1 minus something. Uh-huh.
0.3.
0.03.
So what's the interpretation? So if the variable cost should not be what? Should not increased, because now you're not saying the for sales. So what do you call it now? This one
No,
the
sir,
variable
sir,
should not
Have
we've
we,
not done the
sir, have we done
sensitivity.
the sensitivity, sir, before we
Hey,
interpret? We haven't done the sensitivity.
I'm sorry, I don't know why I'm forgetting now. Okay, thank you for reminding me. So what's the MPV? Our MPV 26.
26.3.
Okay. What do we get in our
239.7.
239.7?
10.9
11%,
or 11.
approximately. Approximately 11%.
10.9, sir. We are using one decimal place.
And that will be 10.0.
10.9.
10.9.
Size
11%. If you're going to approximate, it's 11. Since you
It will
already
be
have
11.
9
It will
as
have
the
11.
answer.
It's 11. 11.0 or 11.
Okay.
Should be 11.0. Can't leave 10.9.
Okay. So what's the
Interpretation.
next one? That's we
Fixed
have fixed
cost.
cost also. Okay.
Yes, fixed
So
cost.
we should just go and do others ourselves. Then we move to the, or how should we do it? I think
So please, what's the interpretation for the variable cost?
the variable cost should not increase more than 11%, because as a cost now is like a, what they call it, like a negative distance to you. So if you're increasing the cost, then it means you are incurring more loss. That's what it means. So the variable cost should not be more than 11%. So if the variable cost is more than 11%, then the MPV will be zero. Do you get? So just
But is
like
it possible
normal,
for it to reduce? Sorry, sir.
you said,
What if it reduces? Is that okay?
of course, if it uses that, that's very fine. But if you are reducing your cost, then it means
Yes.
your sales will increase.
More
Your
profitable.
profit, exactly, yes. That's what it
Okay.
means. So should we solve others and then I'll move to the next question?
So I have a question.
Okay.
Let's move to the next one.
Okay, I came across a question in Pathfinder where we were asked to calculate the sensitivity margin for tax liability.
Okay.
Sir, please, can you explain that?
Eddie, what they mean is that the tax liability you get in your question. In the if you solve the MPV now, for you to get the MPV, you got the tax liability. You
Yes.
understand? So the total tax liability. So MPV divided by the total tax liability. That's what they mean.
So the tax liability now is that's the tax at 30% plus the tax savings, Abi?
No, the tax liability now is not.
Because I need to understand. I'm
No,
confused.
is it the tax savings they ask you to what you will use or the tax your 30%? That's your question, right?
They just said tax liability.
Tax liability is still same thing as tax savings.
So are we going to are we going to recognize the tax at 30% and the tax savings?
No, you only pick. Of course, if you're calculating the MPV, you like the one I did now. So I already incorporate the tax savings in my workings. So,
Yes.
but in my what they call it, when I'm calculating the MPV, I didn't need to put tax savings again. You understand? But
Yes.
if you have got tax savings already, so just pick it then to do your savings margin.
Okay. Okay.
Of course, but if you're using the other way formula, then from your calculation, from where you get the MPV, you can actually pick your tax savings and use to get your savings margin.
Okay.
Yeah. Do you have time to solve the second
So
question?
will you, sorry, sir, can I ask a question?
Okay.
Will you discount the tax liability to present value?
Tax liability.
Do you have to discount? Do you have to get the PV of it, the present value?
If you
To
are
get the,
asked to do that, if you're asked to do that, so probably for the okay, you're asking if from the question, for example, if the one you are solving now and we are asked to do
get the
get
sensitivity
the
margin for tax liability, will
so
it still
if
be
we
NP divided by PV of tax liability or just tax liability like that?
if it's stated in the question, for example, in the requirement, calculate the present value of tax liability, or they say to calculate the tax liability. So just put tax liability and calculate. But if they are telling you calculate the present value of tax liability, but I don't think tax liability needs to be discounted to present value. I don't think so because they are pays in arrears. You understand?
Okay, sir.
So I mean the tax of year zero you paid year one, tax of year one you paid year two, and all that. So I don't think you have to discount tax liability again. But if the requirement says so, then that's what they require from you. You understand? But I've not seen that before.
Sorry,
Okay,
please,
so
to the person that asked,
Pathfinder.
what
you
year
said
is that, or what question is that, sir, please?
I'll look for the year. I don't know how to send it across, but I don't have the year now. But I saw that
Okay,
question.
please, if you have it, you can actually send it across so that others can benefit as well.
No
So
problem.
are we good with this? I mean, we can actually solve the fix this in ourselves. I mean, just the fixed cost. So like I will did it now. The fixed cost divided by the MPV divided by the
Sorry,
fixed cost.
sorry, sir. I want to ask a question, sir.
Okay.
Sorry, I don't know. The idea I have before about sensitivity, like when we did our what is it called? Our MPV, that we got 26.3. As me,
Mm.
I was left if you didn't do it, like if I was to do it on my own, I should have used where is my PV? I would just look for my P. I would have even done this one minus tax whatever.
No,
I'll just
it's
do
from the
my
question. No. It's from the question. You
okay.
understand what I'm saying? It's like we are told, or it's not in the question. I'm coming. Let me check the question.
Can you hear me, sir?
Okay, I'm with you. Yes. No, it's
If I'm left to
for
do it on
4
my own,
years.
I'll just do
Okay.
26.3 divided by maybe my PV of maybe my sales. Let's say for instance, if my sales is 22, I just divide it by 22. So I don't know
But the
why we
22
are
you are
doing this
using
one.
is for 1 year now. The 22 you are using now, that's for 1 year. Hope you know.
Yes, sir. Yes, sir.
Yeah, but this one is for 4 years. Like the project is for 4 years. You get what I'm saying? But
Yeah, I get you.
the actual formula for SA, I mean from certificate analysis is the MPV divided by the present value of to any indicators you are using. Hope you understand. It's the present value of any indicators you are using. So that is the normal, like that's the what they call it. Either the selling price, the sales volume, the variable cost, the initial capital. So that's the present value. So you're supposed to use.
Thank you, sir.
All right, you're welcome. So I think we can solve this fix this ourselves. The fix that one doesn't need much just the fix this thing there. You make your tax, then annuity of 4 years. That is constant already. Then just divide your MPP by what you got. Then you have your way. Then also the cost of the machine. You already know the cost now. So the cost is a 50 what they call it, the 50 million. Then you have what they call it, the our tax savings. You understand? So our tax savings, you'll get the tax savings on capital allowance. So our capital allowance, is the 12.5. Then for you to get the tax savings, so that times 30%. So get your tax savings. Then your present value, you add everything together. Then the difference between the negative costs you have. So if it's positive, then too. So that's just it. Hope you get my explanation.
No, sir. No, sir.
So we should solve it, right?
Yes.
This is what I'm trying to explain. I think the first course we can do that ourselves. I won't.
Yes, we can do the fiscal.
Sir, please, I have a question. I've raised my hand since.
Sorry, I'm not. Yeah, sorry. I'm not.
Okay.
What they call it.
Okay. Please, my question is, I have been thought of solving this sensitivity analysis, but I've never seen them deducting tax. Can you please explain why you're deducting tax? Can
The
you get
reason
the
why we
question?
you're asking the reason why we deduct tax on
Yes, before we now calculate. Yes.
okay, sorry, I'm coming. So the reason why we deduct tax is that the what they call it, this is for the present year, and let's say if the what they call it, if the cost of the project, if it goes up, the profit will fall. Hope you understand. If the cost of the project goes up, the profit will fall. Do you get what I'm saying?
Yes, sir.
So you want to you want to know the impact of the whether the cost or the selling of the or the revenue on the particular return you're having on the particular on the project. So they are always after tax. So if you get all you are doing now, they are after tax. Because it's for the formula, not that I'm the one. So the formula says the present value of so after tax. So it's after tax. But what we've gotten before, we already incorporate tax in our
Okay.
calculation. You understand? So, but it's profit after is after tax. So when you get your sales, so you just remove the tax element there, then you have the normal what they call it,
Value.
the normal tax you needed. I know if I
Okay.
answer your question.
Yes, sir.
Okay.
Okay. Thank you, sir.
Okay, sir, please, I have a question, a clarification to seek from you regarding this sensitivity margin of selling price. We got 8.2%, and you interpreted it as if selling price falls by 8.2%, the MPV will be zero. If it's above 8.2%, what will the MPV be?
It's
If
been
it is
negative.
above, it will be negative.
Yes.
So at what point? Because we still did the last one we did, which is variable cost. So if it is above what we've got, you still say that it's negative. So is it if all of them are above the answer we
Is
got?
the variable cost is what do you call it? So if that one increase, you understand? If the MPV will fall, that's the meaning. Just selling price, selling price and MPV, just the same thing. Like MPV is your profit, is your return you are expecting. So if the sales you are making, if the revenue, the sales reduce, of course the profit will reduce now. If you are selling on naira before, you understand what I'm saying? And based
Yes.
on you want to know the changes. So if the what we sell reduce, of course the profit we are expecting will also reduce. Do you understand? So that's for the selling price to of the MPV. But for the costs to MPV, so if the cost increases, of course the MPV will reduce. For example, what you are buying from 200 naira before, and you are gaining 300 naira, and you are selling it 300, you are getting 100 naira. So if it costs you 250 naira now, you won't get that 200 naira, you'll be getting 50 naira. So as the cost increases, the MPV reduces. Do you
Okay.
get?
Yes, sir. Thank you.
Right. So let's get this one cost of machine. So what's the cost This is what I'm trying to explain. So 72 margin of cost of matching in the that's the MPV divided by the like the present value of cost of machine, right?
We've not done for fixed cost.
I say you guys should do that. And you just get it fixed cost your remove the tax because this one is complicated. That's why I want to do it so that we don't waste most of our time. But if you don't get that, you can actually the case so that I can just explain. But actually, the fixed cost remove the tax element, then deduct it your annual annuity, then get your present value, then divide it by the MPV divided by it, then you get it. So our cost is so we have 50 million, right? So for us to get the tax savings, so what's our capital allowance? And we have the this thing, we have the tax element before, right? So our tax is what's our tax? Our tax is 12.5, right? So to get the capital allowance, that's 30% of this. So yeah, what do we have? Are people still here? What do we have?
Let me calculate it. 3.75.
3.75.
3.75, okay. So to be on this. So what's our annuity? This one is one, right? I think it's year one. So this one is still made the same. 3 point something. 3 point.
3.17.
So what's our present value?
11.9.
Is it 11.9? So you see have
No, for the second one. This one is negative 15.
so so what's our PV now? What's our PV?
38.1.
38.1. So to get the this So what's our MP? 26 point or some three, right? So what do you have?
69.0, 69%.
69%.
69%.
So what does it mean? So this just means that so the cost of the machine must not be acceptable. So if the what they call it, if the cost of the machine increase more than 69%, the project will not be viable or the project will not be acceptable. Hope you get.
Sir,
Can you
that
take it again?
the PV is it not supposed to be in a negative, sir?
Negative as well. We have negative 50 here, we have positive 11.9 here.
Yes. So the PV 38.11 is not supposed to be in negative.
Okay, you mean I'm coming.
The present value of the cost, which is 50 minus 11, supposed to still give us a negative 38.11.
Okay, I understand. Yeah. So what it means is that so what the interpretation means is that the cost of machine must not increase. No, we are still dealing with costs. So you can actually put this in negative and but it's a percent. You understand? So you can't have a negative percent something. I don't know if you get my point.
Okay, yes, I'm getting you, sir.
It's a percent. So what it just means is that this the interpretation is just that the cost of the machine so must not increase more than this 69%. So if it increases more, so for the project to remain viable, for the project to remain acceptable, so the cost of the machine must not increase more than 69%. So if the cost of the machine increase more than 69%, then the project will not be viable. The project will not be acceptable. You get.
Yes, sir.
So that's the interpretation. So the lady that asked about the interpretation, I should recap again. So that's just the simple interpretation about it. So if the cost of the machine increase more than 59%, then the project will not be viable or acceptable again. So do you understand now?
Yes, sir.
All right, so this is just about the question. I don't know if you have time to solve the other one now.
Yes, we do.
Okay. Please, someone should help us with the question. Please, someone should assist us with the question.
Sir, which of the
Can I
illustration
read
are you using? Is two or
illustration 2?
three?
Illustration, true.
Okay.
Okay, Eyigaju PLC
Okay,
plans to buy a new machine. The cost of the machine payable immediately is $800,000, and the machine has an expected life of 5 years.
okay,
Additional investments in working capital of $90,000 will be required at the start of the first year of operation. At the end of 5 years, the machine will be sold for scrap with the scrap value expected to be 5% of the initial purchase cost of the machine. The machine will not be replaced. Production and sales from the new machine are expected to be 100,000 units per year. Each unit can be sold for $16 per unit and will incur variable cost of $11 per unit. Incremental fixed costs arising from the operation of the machine will be $160,000 per year. Eyigaju PLC has an after-tax cost of capital of 11%, which it uses as a discount rate in investment appraisal. The company pays profit tax 1 year in arrears at an annual rate of 30% per year. Capital allowances and inflation should be ignored. Required. A. Calculate the net present value of investing in the new machine and advise whether the investment is financially acceptable. B. Calculate the internal rate of return of investing in the new machine and advise whether the investment is financially acceptable. C. C1. Explain briefly the meaning of the term sensitivity analysis in the context of investment appraisal. Roman figure 2 of C. Using the IR, you calculated in part B. Calculate the sensitivity of the investment in the new machine to a change in selling price and to a change in discount rates, and comment on your findings.
So thank you,
Yeah,
Mr. Omotola. So this is actually a examinable question, like a standard 30 marks question. So it's just like, so there's just if I can want to like make something looks big, so the way they will just put it gamma gamma gamma. So what you just need there, just the points, at least they make the question easier for us by saying we should ignore the inflation rates and tax allowable depreciation. So we are asked to ignore that. I think it makes the work more easier. Assuming the inflation rate is included, so that one is still, we have to still do some permutation here and that. So so we have to calculate the NPV, right? And that's the first requirement.
Yes, sir.
And so the addition should not take much of our time. So how many years do you have?
5 years project.
5 years. So year 0, year 1. Okay. Do you have any tax arrears? So you have any tax arrears then?
No, no,
You don't have?
no.
We have.
Okay, the company is supposed to pay tax in arrears. Okay, yes, we do. Sorry.
Sure.
1 year arrear.
Yeah. Let me put it this way. So do it in a way that it's not stress, so that this is really clear. Give me this thing. This- Okay. So what's our sales revenue? So that's
One
what's our sales.
thousand 600.
So that's for the whole years, right? Or we have
Yes, each year. 1/6 per year.
yeah. Is in dollars. So 1/6, abi?
Yeah.
So do you have any variable costs?
Variable
Yes.
cost 1,100 every year.
Why are we putting sales in year zero?
Oh, sorry,
Supposed to
sorry.
be a new system.
For 5 years now.
I think it's for 5 years, right?
Yes, sir. In fact, it's paid in arrears.
Oh, 6 years.
It's to year 5 and not to year 6.
I thought we have one arrears there now. If that's
Yes,
happening in
but
the
you put
arrears.
That's
sales
areas. That's
in.
why they did 6 years.
Yes,
Oh,
but you put sales in year 6.
so you have first course.
Yes, 160.
Yes, we have this course.
21. So what's our cash flow is what, right?
340.
So it's 340, right?
Yes.
Okay. What do you have?
Please, can that person mute his mic?
Mr. Lucky, please, can you mute yourself?
I can, thank you.
Okay. So what do you have here? See something here.
340 throughout.
Why am I? There's nothing here.
Yes, sir.
Okay.
Tax at 30%.
Okay.
102.
102.
from year two.
So, and in arrears, right?
Yes.
Yeah.
Okay.
So if we paid in arrears, that means there's not supposed to be tax in year one.
So then, what's our initial outlay?
800.
800,000.
3,000 with working capital.
200,000, right?
With working capital.
Okay. So the capital investment is 800. Nothing is there. So what do we have next?
We
So
have
the working
scrap value.
capital, I don't want to merge it together so that they have a transparent, because that working capital, you can see is paid later. So, Abi, we are told just card value, right?
Because I were told
Yes, sir.
at the start year of the operation, the working
Scrap
capital.
is 40,000.
Is it 40?
It's 40.
Okay. That's which year? That year 5, right? What? Okay. You have 90 years.
It says at the start of the first year. That's for the working
Yes,
capital.
yes, yes. See at the start of the first year, because if I should match 90 to this 800, to have but it's still at the start of the, because you can see it's still year zero. You can see still further other year zero. So it's still at the start of the.
Scrap value.
I think we've done that. This is this cap is the 40. So what's our project cash flow now? What's our project cash flow? What's our cash flow?
Sorry, sir, please, I have a question. Why do we have the working capital at the last year as well when the question says the working capital is required for the start of the first year of operation?
Policy, it will come at the early
To
negative, at
come
the end
at
of the positive. At the beginning, it will be negative. At the end of the year, it will be
so what
positive.
is it's working capital. Like it's just something you use to what do you call it? To finance the business for the meantime.
Additional investment.
Normal appraiser.
So we're under investment appraiser. So once you at the first at the year zero, what is negative? So at the end of the project year, it will be positive. So just net each other. Do you understand?
Okay, sir. Thank you.
So what do you have now?
Excuse me, sir. But they say that it should be at the first year of operation. I feel it's supposed to be in year one.
Year zero is the first year of operation now. Like it's a year you are it's that particular you are investing. Let's say this year now. Like this year zero. If I'm investing now, so it's still year zero. For example, if I'm investing now, it's one in next year, that is year one. But they are told in the question that they are investing it now. You get so there's no cash flow for now. So you are investing in the particular project now. And let me go through back to the question again. And the question we are told, so where is it? So additional investments in working capital of $90,000 will be required at the start of the first year of operation. You can see at the start of the first year. So it's still easy, year zero.
Sorry, sir, can I add to that?
You said?
Can I
Yeah,
add
go
to
on.
that? Okay, I think what they mean by working capital will be required at the start of the first year. When they say at the start of a particular year, it means you're supposed to treat it in the previous year, meaning that for that year one, you're supposed to treat it in year zero. If they said at the start of the second year, that means you treat it in year one, then you recoup it at the end of the year. By recouping it, you're making it positive at the end, like at the last year, that's the year five. That's what they mean by that.
So does that answer your question now? Are you clear now?
Yes, sir.
All right. Please can we move forward? So what's our cash flow project now? What do we have here? This was the beginning.
890,
So what do we have here?
340,
Okay, 340. What do you have there?
238,
238. Okay.
238, like that, like that.
The same thing, right?
Now, except for year 5.
So what do we have in the 5?
368.
Supposed to be 278.
Someone say 368. Please let's confirm.
368.
That's
368.
correct.
368.
268. Okay. Then this one we have
Minus 102.
so what are this year? So what percent?
11.
11. So this one here you won, right? So
0.900. 9001, sorry.
what do you have there?
0.812.
Yeah, yeah.
0.731. 0.731.
Okay.
0.659.
659.
Okay, what do you have here?
659.
Oh, sorry.
0.593.
What do you have here?
0.535.
35.
Okay. So we can get our PV from that, right? Oh yeah, that also.
Negative 809.
So what do you have there?
306.
306.34.
306.
306.34, yes.
Let's see. Let's stick to your own number. Let's see if you can. What do you have here?
193.3.
19.
193.3.
Okay. What do you have here?
74.
174.
Okay. Elenko.
157.
156.8. Okay, 157.
158, right?
157.
157. Okay. What do you have here?
218.
218.
55. Negative.
Okay. Okay. Right. So what's our MPV now?
Please, someone should confirm. I think for the year 6 is 64.2.
You said?
The last year is year 6, 64.2 negative. That's 0.53 times 102.
This is 4.2.
64.2.
No,
It's
it's
50,
55.
it's 55. 54.57, approximately 55.
Please let's confirm again, please. Let's confirm again.
Yeah. I just
It's
confirm
It's
it
55,
now.
sir.
55.
It's 55, sir.
NPV is 103.
It's 55. The actual answer is 54.57.
Okay.
So approximately that's 55.
So from the question now, no, we are asked to check to calculate the NPV and advise whether the investment is financially acceptable. So you just comment. So based on the so
Positive
what
NPV.
so therefore the project is financially
Viable.
acceptable or viable or acceptable for anyone. So I think this one is just eight marks, right?
Yes, sir. 8 marks.
But
Sir,
this
I have a question.
okay,
It's
can go on.
majorly on this approximation. Is there a standard? Is the standard two decimal, or we are bound to just approximate to whatsoever we want to?
I think for the decimal, like all these are discounting factor or whatsoever. So I think that one is still three. I think three is still acceptable. But for other what they call it, so except is explicitly stated, like your answer should be in two decimal. So if but you just stick to one what they call it. So aside those what are I mean the discounting factors that that at least the three decimal should be there. But in some examiner like I tell you, okay, oh, your answer should be in two decimal place. So as aside if it's explicitly stated,
Okay, sir.
but
Thank you.
answer to two decimal place, but just stick to one.
Okay.
So the you have to calculate
Yes, sir.
Please, I think we can do this ourselves now. Yeah, please just give us a figure for yeah.
Can we use 8%?
I think what's the initial? No, we can't use 8%. I use the higher rate.
I'm
Higher of what
sorry,
we have before.
14. I'm sorry. Get
15.
negative. I have to increase the cost. 11.
Exactly.
Okay. Can we use 14% or 15?
Yeah, let's use 15. Okay, use 17 so that at least you can be on the safe side.
That's plus 6.
Yeah, use 17, right? Or which one are you using? 15 or 17?
So let's use 17.
Yeah, use 15.
Please, what are we calculating with 15 or 17 that will have a uniform?
Let's use 17 then.
So what are we using? Is it 15 or 17, sir?
Let's use 17 at least so that we have enough gap.
Okay, sir.
So we see how our normal distance, yeah, right? So what do we have here? Year one.
Yeah, one is 0.855.
So what is the discounting factor for here? Oh yeah. What's this here for?
Yeah, one is 855.
0.855.
Yeah.
0.855.
Okay. Oh yeah.
Yes,
0.7.
0.731. 731.
Okay.
0.624.
What do you have here?
0.534.
534. Yeah, uncle.
0.456.
What do you have here?
0.390.
Hope we are on the same page. What do you have here?
291.
291. Okay. Yeah,
Yes,
174.
174.
149.
149.
127.
127. Yeah, 5.
168.
168.
40.
That should be negative, right?
Yes.
Yes.
So do you have negative or positive MPV? So that will be on a safe side.
Negative 21.
ta ló ń kọrin ẹ̀mí fún wa? Please o. Please, let's fix it tomorrow so that we can do that in church. What do we have?
Negative 21.
One.
So we have a negative entity. So what will the RR do? Oh yeah, just do the thing, but don't waste most of our time.
Lower it into brackets.
Yeah, let us calculate it and calculate it. By now I expect us to, but we have any concern to actually look into it. So what's our
16%.
say 16%, right?
Yes.
Okay. So is that so?
Yes.
Okay. That's fine. So are we asked to comment on the changes? Okay. So just to the IRR of 16, right? So we can see
So how
from
did
the
you get
question
it,
that
please?
you said.
Please, I
At all
don't
now.
really understand how you got the
We use
16%.
11 one, we use 70% in the
Use
first
17.
11
one.
and 17,
And 17. So we don't use 16 at all.
not 16.
I don't understand. I think we use 70%, right?
Yeah,
Yes, for
then the
our
first one is
discounting factor
11%.
for
Then we use
IRR.
17.
So what's the IRR? Is it 17?
17.
That's the IRR. Please let's confirm. Someone say 16.
We use 17 for
Use
the
17.
negative
You can
IR.
see it in your calculation too. That's this year at 17%.
He's 17 year now.
He's talking of the answer. You people are giving him the figures in the formula. I think he's talking of the answer.
The answer is
Okay.
16 now. The answer is 16, right?
I will work it out. We haven't worked it out. We don't know.
Yes, the
As
answer is 16%.
The
someone says
answer is
16.
16%. The
Someone
answer
says
is
16. Please, let's
16%.
confirm.
Okay, so people have worked it out. Okay.
Please,
It's
please let's
correct. Approximately 16%. 15.98 is correct. 16%.
If people didn't tell you, work it out and just say 16. So we need to ask now.
Yes, you are very, very right. Yes. So what is the interpretation now? So since what's our initial cost of capital?
Initial cost of capital is 11.
11%.
11. So since the internal rate of return is higher than the cost of capital now, so should the project be accepted or rejected? Or is it viable or not viable?
It's viable, should be accepted.
Viable. So since the IRR is greater than the cost of capital, then the project should be accepted.
Accepted.
You understand? So that's just the interpretation. Because assuming the internal rate is lower than the cost of capital, then the project should not be accepted. Then what's number C? What are we asked to do? Education should that one is not. What's our requirement C?
Meaning
Explain
of
briefly the meaning of the term
sensitivity analysis
sensitivity analysis in the
in the
context
context
of
of
investment
investment appraisal.
appraisal.
I think we can do that now. So we have to note already. So just explain
Motion.
so the sensitivity analysis. So it just like I explained earlier on. So for an investment project, so the SA, that is sensitivity analysis, it just it's explain the change in a variable in the ability of a project. So I mean so that the project can be calculated as the ratio of NPV to the present value. That is, you are considering the indicators of um, of the project to the return of that particular project. For example, sales now, you know, so you want to determine the sales of what you earn. So compared to the return you will earn if you invest in it. So if the sales decreases, then the project, the return of that project will decrease. Then if the sales increases, then the return of the project will increases. However, also if you're considering other factors like the cost of the variable cost, so, so if the variable cost increases, then the return of the project will decrease. So that's like a what do they call it? So they have negative correlation. So if the cost of the project increases, then the return of the project will decrease. So another way around like that. So it just shows the what they call it the essay shows the intake change. So the variable that which will the NPV will become zero. The project of the NPV will become zero. So that's just the. So should you put it in a short form? But you have to note already over there, so you can actually go through that and so I need to understand. Hope you understand, sir.
Yes, sir.
Sir,
Yes, in Miss Ore, right? Yeah, say something.
No, I said yes.
Okay, okay. So what's the next one? Oh yeah, Miss Malola, help us. So what's the next one?
Omotola,
Oh, sorry, Motola.
using that is Roman figure 2 in C. Using the R you calculated in part B, calculate the sensitivity of the investment in the new machine to a change in selling price and to a change in discount rates, and comment on your findings. 6 marks.
6 marks. Wow. So we have the selling price, right? The selling price. So no, we have 5 years and 80. So like I said, so you don't forget to discount to the present value. It's very, very important. So what's our sales units?
100.
100 watts. 100,000, right?
Yes.
Okay. So
Yes,
first,
sir.
let me just put this so that um so what's the price? Hmm?
16.
That's
16.
it.
Dollars.
So what's the annual on it? What's the annual?
1.6 million. Okay, I need to, sorry.
No,
So
that
are we not netting it off tax?
we'll do that.
That unit is 100, not 200. Oh.
Oh, sorry. So what's the annuity?
3.70.
3.70, right?
Or 3.696. Sorry.
Okay. So no, this one you have to get total first. Yeah, this but before you multiply it by this. Let me see. What is total of this first?
160,000.
160,000.
So what do we have here?
So it's 1,600,000.
Hmm?
1,600, not 160.
1,600. I don't understand that thing.
The total is
1.6, 1.6.
1,600,000, not
1,600,000.
160,000.
1,600,000.
Okay.
1 million, yes, the remaining 10 at the front of the 6.
Okay.
Yes, correct.
So what do we have?
5,913,600.
I don't know.
5,913,600.
So for us to get the tax liability down, you understand? Because we are told the tax we are paid in arrears. Hmm? So let's get tax. Right? So what's below our tax? What's our tax? Sorry.
We're calculating the tax on the total price, right?
Yes.
$1,139,520.
Hmm?
Is it not on that 5 million, sir? The tax is on that 5,913,000.
Yeah, 30%.
I thought the tax was on the total, not the present value.
Yeah, on the total now the 5,9
If it's the total is 480,000, sir.
480,000.
Yes.
30% of 5 9. Okay, can be 480,000.
Should be one
No,
seven
we're doing
seven.
30. We're doing 30% of 1,600,000, not 5 million.
Okay.
And sorry, sir, what we did before, we actually subtracted our tax from the total before applying our annuity. But I don't know why we're doing it in the reverse form now.
No, we're supposed to select our tax before annuity, before applying our cost of capital now.
Okay. Yeah, we should drop the tax before the annuity, right?
Yes, sir.
Yes, that's what
Yes,
I
sir.
was saying at the beginning.
That's what you applied the other time.
Yes.
Okay. So what do you have now?
So our tax is 480,000.
This one. So what do you have at the
The total will be 1,120.
$1,120?
That's working in thousands. It's the same thing though.
$1,120.
Yes.
10,000.
It's a million though. You can see add the 3 zeros.
Okay. So what's next now?
The present value.
So what's our present value now?
4,139,520.
Hope we get it, sha. Hmm?
So I thought that this that's our
Tax.
annuity is supposed to be on 1,120 and not
Yes,
1,600.
that's where we calculated it on. But the way it's arranged here, I think that's what will confuse some persons. You can delete that 5,000, 5 million out.
You know, this is the total, what do you call it? This is the total, no, this is the
No,
price that total
that
sales.
yes,
Yeah, so,
that 5 million is wrong, sir.
That 5 million is no longer relevant. It's a wrong person.
okay, I did not delete it earlier on. So what's our PV now?
It'll be 413.
Oh yeah, now. Please let's calculate and
Come on.
I don't even understand what's going on.
4139520.
4139.
I think it is the arrangement.
Five
That
two.
one, the annuity should come under the 1,120,000.
The annuity
So
should come after the tax, sir.
But you see the same thing now.
It's scattered.
confused, sir. Some people are
It's
confused.
for
Some
easy
people will be
understanding.
confused.
Let's put it this way.
439.
It should
Hmm?
be exact.
Yes.
So what do you have now?
4,139,520.
4139520.
139,520.
520.
520, Telavi.
Yes,
Yes.
zero. That's it.
Okay. So that's the present value. So to get our what do you call it now? What do we our sensitivity now?
That's our MPV of
So what's our MPV?
So since we have two MPV here where we work with IRR, which of them are we supposed to
No,
pick,
it's the
sir?
first one now. No, we are told in question that suppose we are using IRR, because you can see using the IRR you calculate. So is the IRR you are using the second one?
Okay.
From the
Which is
first
16%.
yes. So what's the next person you are doing? So what's the MPV now?
21,000.
Okay. Mm-hmm. Divided by what? Divided by this.
Sorry, where is the 21,000 coming from?
So what's our MPV? What's our MPV for the IRR?
Okay.
Then
Divided by
divided by
4,139,520, which is 5.07.
so what do we have?
5.07.
So what does it mean? So it means the sales value, the sales price, so should not be more than 5.07, right?
Excuse me, please. After multiply with 100 is 0.51. It's not
Yes,
5.51.
0.5%.
Yes. Ugh.
Please, let's calculate this one together. I know
I've confirmed it, sir. Let other people try. It's 0.51.
Size 0.51.
It's 0.51%.
Not 0.0, sir. 0.5.
okay,
Yeah.
0.5. Okay.
That's the answer.
My voice is so scared.
It's not 0.54.
So we just interpret that effect. I explained the one. So what's the next one? What are we actually doing again?
Discount rates.
So and the discount rate. So what is discount rate? So no, we have a so do we have any for first of all you have to check for the changes in discount rates. So what the change in discount rates?
Is it not that 16%? The one for the IR.
Well, what's the
16%.
So our IR is 16, right? What's our initial? So we have 5. So we have 5%. So our initial, our IIR minus the initial cost of capital use. So the difference is 5%, right? You get what I'm saying?
Yeah.
So,
Yes.
Yes,
so
sir.
now,
Yes, sir.
We got
now
it, sir.
okay. For us to get the sensitivity of the project,
So I thought the discount rate, the higher discount rate is 17%.
no, what we are
The one
getting
we got for the IR is 16%.
percent. So the 3% minus the initial weight used.
Okay.
So it will be the changes divided by the initial the changes in the what they call how you do your year change now, year change. So the difference minus the initial figure. So the difference is the 5%. The 5% divided by this particular initial rate. So what do we have?
45%.
45%. So what's the meaning? What's the interpretation? So the insurance can be reduced as so as the selling price of the investment. I'm coming out this 45%. So 16, 11 as 5% increase. So for the on the question, do you have any? If you are told to calculate the sensitivity of the investment in the new machine to a change in selling price and to a change in discount rate. Okay, okay. So
Change
from
at
the
the rate
scenario,
of 5%.
so the critical variable is the selling price, as you can see. So as the investment is significantly more sensitive to changes in the sales price than the discount rates. Do we get?
Please, I take it again.
Aside from the scenario, from this particular scenario, so um the investment, the selling price, so is more sensitive to change, is more sensitive to changes in the sales price than the discount rates. Should I explain that?
Yes,
Yes,
please.
sir.
Okay. No, the discount rates, the selling price increased from. So what the changes in the selling price you calculated?
Zero point five
Zero
one
point
percent.
five one percent.
Okay, just use of go for 5%, and this discount rate is 45%. Okay. So the selling price, the critical variable is the selling price. So in the sense that as the selling price increases, so it has a positive correlation with the return. I mean the selling price. So if the selling price increase, the return will increase, right? So for this particular rate of return, the discount rate. So it means um if there's a change in sales price than discount rates, then it means the selling price is more sensitive, like sensitive to changes than discount rates. Do we get?
No, sir.
Oh, God.
But the discount rate percentage is way more than the selling price percentage.
Yeah. But no, the change is just 5%. You understand? Like what changes in the what they call it? The what is required from the discount rate to change for the discount rate to zero is just 5%. You understand?
Yeah, but for selling price is 0.51, which is
Yeah,
less than 5%.
which is less than 5%. So what I'm not trying to explain is that the selling price, like, is sensitive in the sense that it will, if the selling price come up, like if it increase more, you understand, then the what they call it, so it won't result in negative return, negative NPV.
So can
If
you
the
just
selling,
please help us write it out?
okay, let me put it this way. Um, so as it's still be able to selling. Uh, um, sneakers. So what I'm trying just to explain is that the changes that will occur from the sales price if it increases, so is most dependent upon that on the discount rates. Like if the sales price increase, it will affect the NPV for it to be zero more than it will affect when it changes the higher or lower the discount rates. Do you get? If the discount rate, if there's a, if there's a, for example, discount rates move changes from 5% here. So these changes will not affect more on the return than it will affect more if there are changes in the selling price. Do you get? And the selling price, like it has more weight to the return more than discount rates. The changes in the selling price has an effect more than changes in discount rates. Did you get? Irrespective of whether the discount rate is
Yes, sir.
higher
Yes, sir.
or lower, because the selling price itself is like an integral, what do you call it? Like it is more of integral to the NPV than discount rates. No, the discount rate you are just comparing for the NPV to have a negative figure. But for the selling price, you're actually comparing and want to know whether you have a higher return or you have a more lower return. I don't know if you get my point. So so what we're actually about is the effect, the what they call it we have, selling price we have more than the discount rate sensitivity. The selling price sensitivity is um, more of concern than the discount rate sensitivity. So from discount rates, now you can see what changes is just 5%, but from the selling price, what they call it, if the selling price changes for 5%, assuming it's your selling price, so the changes that you have on selling price will be more than discount rates on the NPD. Did you get? Did you understand? Ah,
So I think we
So,
can work. We
so
can work
we'll
with
manage
that.
it like that.
We can work with that.
We'll manage it.
divided is what? It just okay. Just put it this way: the selling price, the selling price, like the effect the selling price has is more than discount. The changes in selling price is more than this changes in discount rates. So that's just the meaning. So even though the discount rate changes higher than selling price, doesn't mean the discount rate has more, what do they call it, more effect at the selling price. So the selling effect attract the return in the sense that once the selling price increase, any changes in selling price like this, the return will rise. any decrease in selling price, the return will reduce. You understand? You can see, so the what they call it, the selling price has a positive correlation with the return. But discount rate is not like that. So the discount rate can still you can say, okay, let's put this way. No, the discount rate before is 11%, right? If the what they call it increase to 12%, it if we increase the interest rate to 30%, the return will reduce now. It's not. We get.
Yes, sir.
Uh-huh. But any significant changes, increase in selling price, the NPV will rise. But just put it this way, the selling price has a positive correlation in the sense that once any changes, any increase in the selling price will automatically lead to an increase in the return, the NPV. However, in the any changes in discount rates, any increase in discount rates will automatically reduce the return, the NPV. So they have a negative correlation. So as long as the return is increasing, the NPV is reducing.
Okay, sir. Thank you, sir.
So that was, even though the NPV has 0.1%, so it's still an increase. But in this, once the discount rate increase, it will affect the return. The return, it will reduce the return.
Okay, I think it's clearer now.
It's clear now.
Yes.
So just a positive and negative correlation. So just as the cost we discussed earlier, just as the cost that has negative correlation. So
Yes.
also the discount rate. Hope we got it clear now.
Yes, sir, it is very clear.
All right. So I think that's the end of their question.
I have a question, sir.
Okay, Mr. Tunde Abiot.
Our annuity, sir. What rate do we use for our annuity?
Great. If you are doing year by year, so just the discount factor than the year. If you're using year by year, so it will be 1 point, if it's 1.1 plus half, x of our number of years you are using.
I want to know the rate that we use, the percentage rate, sir.
It's 11% for annuity. It's 11% that we used all through.
11%.
Yes.
Thank you.
It's still the cost of capital we use for the annuity.
Okay, thank you.
Yeah.
Sorry, I have a question.
Okay.
Okay, how we got the IRR? The formula, is it the lower rate plus NPV of lower rate all over NPV of lower rates minus NPV of higher rates, right? All multiplied by higher rates minus lower rates. Is that the actual formula?
Yeah, that's the formula.
Yes.
Just
Yeah, because I'm not getting 16% using
okay.
this formula.
What are you getting? Maybe
I'm
you
getting 18. Because
18.
we used the first rate we used was 11%. Then where we now
Yeah.
used for the second one we used 17.
Yes.
So we had NPV of 103 in the first one, and then we have 21 in the second one.
Yes.
So I assume now 103 divide by 82.
You're
Then
correct. You're correct.
it's 18, right?
Yeah, 18 plus 18 points.
Okay,
Oh,
because I'm just trying to.
121, 21,
No, positive
102.
NPV minus negative NP will give
That
you
means plus.
positive.
One
Okay,
plus
okay, so it's
102.
plus.
Yes, it's
Yes.
plus. Automatically it's plus.
Okay, okay. Thank you.
Are you good now?
Yes, sir. Thank you very much.
Okay.
Even
So
with
that
your approach, when you did that annuity, when you wanted to minus the annuity before your tax, you have even given us the same answer. You were very correct from the beginning.
okay, the one I
When
used
you were
the
doing the annuity before your tax, we arrive at the same answer.
yes, of course. Yes,
You're very correct.
I see
Thank you, sir.
answer that. All right. So for the third missing, third question, you can give it a try. So, but I'll see how I can send the probably on Monday. I can send the solution to you guys. So because practice it against tomorrow, just as we did the what they call it now, the section one and two. Actually practice the section three. Then you then need the so or you have any concern, you can actually reach out so that you can actually tackle it together. But this all these are actually examinable question, like examining. So so that's just it about scientific analysis. So our next now we're thinking about the decision tree. So this is just all about scientific analysis, nothing more than all this. And I don't think they can actually twist the question. And if they want to twist the question, just to add the real cash flow. So that's just the only thing they can add. You are actually done that in your investment appraiser. So you don't need to worry much about that. So that was it about not anything about this. Right? So do you have any questions before we call it today? So I think
No, sir.
there's no more questions. Okay?
No,
No, sir.
All right, that's fine. That's fine. So
good
I
night,
wish you
sir.
guys good night, everyone. So have a nice dream.
Good night, sir.
Good night, sir. Thank you so much.
Happy Sunday. It's a Sunday already. So
Thank you, sir. Good night, sir.
good night.
Thank you so much, sir. Thank you very much, sir. Thank you, sir.
See, has been waiting to leave since.